To ETH or not to ETH? That is the question. It's been a little over a week since the Ethereum London hard fork, and since that time, ETH has gone from strength to strength. Indeed, the renewed confidence in Ether has had most of my followers asking me whether I'm still bullish and how much more upside potential there is. This, of course, was the sign for me that an updated ETH video was long overdue. So, today I'm going to be doing a deep dive on Ethereum once more. I'll be explaining just how the London upgrade could impact price and what this all means for ETH 2.0. I also have a few predictions of my own that you guys cannot afford to miss. So, be sure to stick around. Before we lift off on our mission to the moon, we need to make sure this launch is safe. Now, I may be a crypto astronaut, but I am not a financial advisor. Nope. Turns out the rocket scientists are not qualified to give financial advice. Who knew? So, everything that follows in this video is for demonstration and educational purposes only. Affirmative? Good. Now, if you're new here, you must be lost. My name is Guy Lightyear, and I am the captain of this Coin Bureau rocket ship. So, if you'd like to join me on that intergalactic journey into the cryptoverse, then you can grab your ticket by smashing that subscribe button and pinging that bell. That's right, Richard and Jeff. I'm giving these space flights away for free. You billionaires are all the same. Yes, one more thing. If you look at the video timeline, you will see all the emergency exits. Hit one of those if you need to bail out of the spaceship to another section. However, using one of these exits during flight will damage the rocket's reach. Okay, ready for liftoff? To infinity and beyond. First off, I need to explain what the London upgrade was and why it was so important to the Ethereum network. Essentially, this was an Ethereum upgrade that incorporated a number of Ethereum Improvement Proposals, or EIPs. The name is self-explanatory. One of the most consequential of these was EIP 1559. This was an EIP that was in the works for some time and was designed to radically change the way that the Ethereum transaction mechanism works. Quite simply, it would eliminate the method by which users would compete for block inclusion through a bidding system. Users would bid up the gas for the transaction, and these fees would be earned completely by the miners who were pushing the blocks forward. However, this often created an incentive for miners to bid up these fees through a tactic called miner extracted value, or MEV. Anywho, what EIP 1559 would do is it would change how the amount of ETH required for a transaction is calculated and where that ETH goes. There would be what is called a base fee that would be determined by the network demand and would be dynamic. This fee would be burned, i.e. eliminated from the ETH supply. On top of this base fee, you would also have a priority fee. This is also called a tip that would be paid to the miner in order to prioritize your order into a block. Now, of course, there's a lot more to EIP 1559 than that, but I've linked to the resources below that you can read at your leisure. However, the most important thing to focus on when it came to this particular EIP was that base fee. Because it still reacted to network demand, it would not materially impact the amount of fees being paid. However, because it was being burned, it would lead to a long-term accretive benefit for all participants. Miners were not too happy about it, and they said that it unnecessarily targeted them. However, despite their objections, the upgrade went through. At block 12,965,000 on the 5th of August, London went live. And here is a pic of me in London at the exact moment it happened. I was slightly nervous because it was such an important upgrade and because so much of my portfolio is in ETH. However, the upgrade went through as smoothly as anyone could have imagined. You can take a look at this tweet by core dev Tim Bako. Over 96% of all Ethereum nodes had upgraded to the new clients and all mining pools implemented the new code. In fact, it was the first time in Ethereum's history that there were no blocks mined on the old chain post-fork. Moreover, gas fee limits were steady at the target 30 million, and gas usage distribution lined up pretty damn accurately compared to the models. Now, while this may sound like mumbo-jumbo to you, it's important as it shows just how well coordinated and planned this upgrade was. It's a harbinger of things to come with ETH 2.0. But let's not jump the gun on that. The most important question for us users right now is what this means for ETH tokenomics and usability. As if on cue, ETH started being burned as base fees began to be paid. There are a number of websites that track the burn rate, but at the time of shooting this video, we had over 28,000 ETH burned and counting. This equates to about 36% of all the ETH that was issued. So what that basically means is that the ETH inflation rate has been reduced from about 4.2% to 3%. Now, what's important to understand here, though, is that it's not deflation, but a reduction in the inflation rate. That's because you still have block rewards that are being awarded to the miners. However, due to that burn, the emission rate has been reduced. And you can see exactly what that looks like with this graph over here. Now, of course, this should still be bullish for ETH. Think about it like this. If you are willing to pay X for ETH before the upgrade based on the level of scarcity and demand in the future, surely that scarcity price should be worth more in the future post-fork. This is exactly the reason as to why many people place so much emphasis on Bitcoin halvings. A reduction in supply growth impacts on asset scarcity. It's not only that, but it's the fact that there should be less sell pressure on the market. Miners are more likely to want to hodl ETH on their balance sheets than sell immediately, precisely because they think it will be worth more in the future. Of course, less selling pressure by miners means less impact on the price. This is perhaps the reason as to why ETH rallied post-fork and didn't dump as many may have been expecting. Then, when it comes to fees on the network, there wasn't a particularly marked change. Some users were disappointed, but as mentioned earlier, this was not the goal of the upgrade. There is a benefit, though, when it comes to the usability. Whereas before, users would just pay a gas fee that they thought would get the transaction through, they now have two more transaction parameters. They can set both a max fee for the transaction and a max priority fee. The max fee is the maximum they are willing to pay for the transaction in total. This will include the base fee and the tip. If the base fee is above the max fee, a transaction will not go through. However, by further adding a max priority fee, the user can be more specific as to the amount they're willing to pay for a tip. Therefore, if the max transaction fee is below the base fee plus the max priority fee, the user gets a refund. I'll link to some guides below that could further help you understand the new mechanism. Now, apart from this, another reason why the new transaction mechanism is more user-friendly is because the user can easily send an optimized base fee at the moment, knowing exactly how much it is. They have certainty around their transaction at that block and do not need to guess about gas fees for future blocks. Now, of course, this benefit will be more noticeable to those of you who are regular DeFi users. But it's what EIP 1559 means in the context of the upcoming ETH 2.0 upgrade that's the most exciting. This benefits us all and in a big way. So let's take a look at that, shall we? I presume that most of you have at least a fair understanding of Ethereum 2.0. This is the long-awaited update that will transition Ethereum away from proof of work to proof of stake. Not only that, but we'll also see other scaling technology, such as sharding, implemented on the network. I've linked to some of my previous videos on ETH 2.0 below for you to watch at your leisure. Now, the ETH 2.0 roadmap has it going through 3 stages. We've already been through phase 0 with the beacon chain. However, the next stage is phase 1, which is the proof of stake merge. It's at this stage that we will move to proof of stake. Now, proof of stake will, of course, be a lot more scalable, which will bring with it reduced transaction fees and faster transactions. If you want a full breakdown of the differences between the two consensus mechanisms, then you can watch my complete video on it. Feel free to hit that link in the top right so that you can come back and watch it later. Now, this ETH 2.0 merge is most likely going to happen sometime early next year. What's most important about this transition is the impact that it's likely to have on the amount of ETH being burned and emitted. Now, I want to draw your attention to this spreadsheet. It was drawn up by senior Ethereum researcher Justin Drake. Oh, come on now. Yes, that's the one. Justin Drake, one of the lead devs on Ethereum 2.0. Honestly, you can't get the staff these days. Anywho, in this spreadsheet, he has completed a number of rough calculations around ETH supply, return, and burn rates on the Ethereum network post-merge. It's really quite illuminating, so let me quickly walk you through it. Over here, you have the range of cases about when the actual merge could happen. The best guess, or average estimate here, is March next year. Given that this is the one that Justin himself used, I'm going to use that one myself. I'm only going to point out some of the most important numbers here. Firstly, on the date of the merge, the ETH supply is estimated to be about 120 million ETH. Assuming all the other parameters like the amount staked, etc., the spreadsheet estimates that we will have 2.7 million ETH being burned a year and 963,000 ETH being issued. So, this basically means that the amount of ETH burned is exceeding the new ETH supply. That would make it a deflationary asset. An asset with a supply that's falling every year. One that the ETH developers have labeled as ultra-sound money. Based on these projections, it would take about 11 years or so for ETH to reach a supply of 100 million ETH. Not only that, but Justin has also calculated the reduction in the selling pressure of ETH on the open market. In total, about 7 million ETH will not be hitting the open market as a result of the upgrade. This is price positive, of course, because price reacts to the balance between buys and sells. So, those numbers look incredibly optimistic to me. We can also take a look at these projections based on some of the other scenarios over here. Even in the less optimistic and conservative estimate, we would be burning 1.3 million ETH. With the same issuance rate, that would still make ETH deflationary. Daily sell pressure would also be reduced to 5.4 million ETH. The point of the matter is that post this merge, ETH could have a deflation rate of 1.4%. Now, Bitcoin has an inflation rate of 1.8%. USD Fiat has an inflation rate of over 5% currently. So, now do you see why ETH can be considered ultrasound? I will, of course, emphasize that these are just estimates. The model is based on inputs for fee burn rates and staking growth at this point in time. However, I don't think the numbers are likely to change that much. If you were to ask me when the merge were to happen, I would personally lean conservative. We know from past experience that development work takes a lot longer than expected, especially on such a large open source project as Ethereum. So, things are looking pretty bullish from a tech perspective. However, there are a number of other fundamental factors that could have a large influence on the price of ETH in the medium term. Let's start off with a few on-chain stats. The first thing that I like to take a look at is the exchange balances. This is because it can give you a decent overview of how much ETH is likely taken out of tradable supply. So let's hop on over to Glassnode and take a look at that metric, shall we? As you can see from this graph, ever since the beginning of the year, the amount of ETH held in exchange addresses has been on the decline. We went from just over 19 million on exchanges to below 16 million today. That's over $9 billion in ETH that has been removed from order books. Now, of course, it's not just about the lack of ETH on exchanges. It's about where this ETH could be going that's the most bullish. Allow me to present Exhibit B. This is the total amount of ETH that's being held in smart contracts, and it has been on a sustained rise this year. This is ETH that is most likely used in DeFi protocols in order to supply liquidity, earn interest, or other types of yield farming tactics. The point is that this ETH is being used for a specific purpose and to generate yield. Therefore, those that control it are less likely to want to sell it than those who have ETH just sitting in a wallet doing nothing. Here we have another graph. This is the total supply of ETH that's held in wallets with a balance of more than 32 ETH. The reason that this is important is because this is the amount of ETH that's required in order to stake ETH on the Beacon chain. This can further be checked by taking a look at the amount of ETH that is now being staked in the Beacon chain smart contract. This currently stands at over 6.6 million ETH, and it is climbing. ETH locked in the 2.0 staking contract is even more consequential, as this cannot currently be withdrawn until the proof-of-stake merge. As is laid out in that sheet by Justin Drake, the most optimistic estimate for when this could be is as early as February. However, as I mentioned, it's more likely that this will be pushed to a conservative timeline, the 1st of April. So, until that time, $19.5 billion in ETH won't be coming near the open market, a number that is continually rising. Okay, so the on-chain metrics are screaming bullish. But how are things looking in the institutional space? This has, after all, been the dominant theme over the past year. The poster child of Wall Street is, of course, Goldman Sachs, and it has become increasingly active in its commentary about the crypto space. According to Business Insider, a few weeks ago, GS sent around an internal note that said Ethereum could one day flip Bitcoin. This was based on the observation that Ethereum is, quote, the platform on which it is the native digital currency is the most popular development platform for smart contract applications. As I pointed out in my previous video on Ethereum, Goldman decided to offer Ethereum-linked futures and options before it had similar Bitcoin instruments. So the recent internal note effectively puts that into context. Oh, and by the way, if you guys wanted to find out what else Goldman thinks of crypto, feel free to watch my video on the topic. That's linked to in the top right for you to come back to later. Moving on though, another really important report that came out recently was Coinbase's institutional investor report for the first half of this year. It was a really comprehensive report, so I've linked to it below should you want to read it yourself. But there were a few really insightful points for me in it. Firstly, when it comes to exchange volume, ETH trading volume has literally skyrocketed. Last year, volume was at $92 billion. This year, it was 1.4 trillion. Yep, that's right, a 1,461% increase in volume in just a year. Coinbase also commented that, quote, many of our largest institutional clients, including hedge funds, endowments, and corporates, increased or added first-time exposure to ETH in H1, believing the asset has long-term staying power tantamount to BTCs. I should also point out that Coinbase released their Q2 financial results recently as well. Q2 of this year was the first time that ETH overtook Bitcoin in trading volumes on their exchange. Another really interesting institutional report that you guys may want to take a look into is that of Genesis Tradings. This is an OTC dealing desk that's based out in New York and has been brokering regular institutional block orders for a number of years. Here is a graph that shows the share of trading volume that has been taken up by certain assets. As you can see, Bitcoin trading volume has fallen from over 80% at the end of Q2 last year to roughly 47% of trading volume in Q2 of this year. Taking a look at the ETH volume, it's a different story entirely. ETH volume was less than 5% of Genesis trading volume last year, whereas this year it was up to 25% of Q2 volumes. Another graph in the presentation is that of the BTC market cap to ETH. As you can see, this has been on a material decline since the beginning of the year, and they state this, quote, shows the expanding role of ETH as an institutional portfolio asset. Okay, so that's all really interesting, but what could this all mean for price? Well, the fact that you have so much demand for ETH with a limited supply is bullish enough as it is. However, there are a few other data points that we can look at to get a sense of where the market thinks ETH could be headed. When it comes to pricing assets in the future, it helps to take a look at what's going on in the options markets. That's because these instruments reflect the market's best estimates as to the potential price on expiries in the future. Firstly, I want to bring your attention to this article over here on CoinDesk. After the London hard fork went live last week, ETH options activity picked up quite a bit. This volume was mostly in call options, which, given their option to buy, are a bullish sign. But it's not just the type of options that were being sold that were interesting about this market flow. It's also the strike prices of these options. The most popular options were those that expired in March of next year with strikes of 50k and 40k. Most of these deep out-of-the-money call options were traded on Paradigm by institutions, further proof that there are some really optimistic bulls out there in hedge fund land. One more thing that you can look at is the price that investors are willing to pay for calls relative to puts. Obviously, if the price of calls is higher than that of an equivalent put with the same sensitivity, it's more of a bullish sign. The way that this is measured is with the option skew. Now you can see how the ETH 25 delta skew has been evolving in this chart. For options with a range of different expiry dates, the skew has been falling. This therefore means that calls have been becoming more expensive than puts across a range of expiry dates, bullish across the term structure. Now anyways, if all of this stuff is Greek to you, don't worry. I did a video last year on how to read option market data, and that, my friends, is in the usual spot. Well, that's it for most of this video, folks. However, I do want to round off with a few of my own thoughts. As you can no doubt tell, I'm quite an ETH bull. It's hard to take a look at all these fundamental factors and not be incredibly optimistic about its future. The London hard fork has shown just how smoothly the Ethereum community can execute fundamental protocol upgrades. It was a great demonstration of what we could expect to see when the 2.0 upgrades start being rolled out. And with that proof-of-stake merge, we're going to see ETH become ultrasound money. Money that will have a deflating supply year on year, day by day, block by block. And it seems as if most of the crypto community agrees. ETH is being stacked, staked, and otherwise removed from the open market. It's being held as a rare store of value that will be in much shorter supply 1 year from now. And of course, it's not only us that are trying to hoover up that ultrasound money. Institutions are chomping at the bit, or should I say ETH, as they continue to accumulate more of it. This is a theme that I don't see slowing down anytime soon. Taking all of these factors into account, I can see why options expiring next year have such high strike prices. Market momentum is on our side, and the ETH bull is not running out of steam. So I want to leave you with this final thought. If ETH was at 17K, that would give it a market cap equivalent to that of Microsoft. Is that inconceivable, knowing exactly what Ethereum will one day be powering? That's it, chaps and chapettes, my update video on Ethereum. Of course, no video is complete without all your important input. So, where do you guys think ETH is headed? And when do you think we could see the proof-of-stake merge? Fire your comments as ever below. And while you're down there tapping away at that comment, I absolutely have to let you know about my socials page. It's over here where you'll find the only official links to places you can follow me. These include my Telegram Insider channel, where you will get daily market updates, Twitter for announcements and the occasional shitpost, Instagram and TikTok for behind-the-scenes fun and memes, and finally, my weekly newsletter. This once-weekly email comes with a spam-free guarantee and includes my weekly thoughts as well as a peek into my personal portfolio. So be sure to head down below and hit that top link in the description. If you like this video, then you know what to do. Make that like button blue and don't forget to subscribe too. Oh, and the bell. Don't forget it or it will get lonely. You don't want to miss what else I have coming down the pipes. So till next time, Crypto Cats.